You set up the automatic contribution, chose the target date fund or the S&P 500 index, told yourself you were doing the right thing, and then you did something almost everyone tells you to do. You stopped thinking about it, set it and forget it. The most repeated phrase in passive investing. And every time the market dipped and you didn't panic, every time you resisted the urge to check the balance during a bad quarter, you felt like you were winning. Like discipline was the strategy and the strategy was working. But there's a version of that discipline that costs you. And nobody talks about it because the alternative sounds like the thing you were specifically told not to do. This is about the cost of forgetting. You've probably been told the index fund story so many times it feels less like advice and more like scripture. Actively managed funds underperform the index over time. Time in the market beats timing the market. Fees compound against you just like returns compound for you. Diversification is protection, and all of it is true, every piece of it. The passive investing revolution was a genuine correction to a financial industry that had been overcharging for underperformance for decades, and the people who championed low-cost index investing were right to champion it. The data is unambiguous, but the data is also from a specific period, under specific conditions, applied to a specific set of investors, and the lessons people drew from it got simplified into a rule: set it and forget it. That has become so deeply embedded in the personal finance conversation that questioning it feels almost reckless. Like suggesting you don't need to wear a seatbelt because most short trips end safely. You're wearing the seatbelt. The question is whether you're also watching the road. Think about your investment account right now. When did you last actually look at it? Not the balance, but what's in it. The allocation, the expense ratios on each fund. Whether the auto contribution amount you set up 3 years ago still makes sense for the income you have now. Whether the target date fund you chose is calibrated to a retirement date that still matches your actual plans. Whether the diversification in your account is real diversification or the illusion of it. Multiple funds that, when you look at the underlying holdings, are largely owning the same things. Most people don't look. That's the instruction. Don't look, stay the course. The market will do what the market does, and your job is to not interfere. And there is genuine wisdom in that instruction for the specific failure mode it's addressing: the panic seller, the market timer, the person who pulls out in a correction and misses the recovery. For that person, the discipline of not looking is life-saving. But there's another person the instruction doesn't fit. The person who isn't in danger of panic selling. The person whose problem isn't emotional reaction, it's informed neglect. The person who set something up years ago, correctly for who they were then, and has never revisited it since, and whose financial life has changed substantially in ways the original setup cannot account for. That person is also following the rule, and the rule is costing them. And this is where it gets interesting, because the passive investing philosophy, correctly applied, is not actually about ignoring your investments. It's about ignoring short-term market noise while remaining actively engaged with the structure of your portfolio over time. The set it and forget it interpretation, where you make a one-time decision and then never revisit it, is a distortion of the original argument. The original argument was, don't try to time the market, don't pay high fees for active management, don't trade based on fear or greed. It was not, make a single allocation decision at age 28 and let it run until you retire. But that's the version that spread because that version is simpler. And simpler spreads faster than accurate. Think about who you were when you set up the account. How much you were earning, what your timeline looked like. What your risk tolerance actually was versus what you marked on the questionnaire. How much you understood about what you were choosing, and then think about who you are now. The income is different. The timeline is different. The understanding probably is different. The life is substantially different. And the account is running the same instructions it received from that earlier version of you without any acknowledgement that the person giving the instructions has changed. Nobody told you to go back and update the instructions. You were too busy not panicking to notice the autopilot was miscalibrated. The game changed and nobody told you. Here's what nobody tells you about money. The index fund is not a strategy, it is an instrument. And like any instrument, its value depends entirely on how it's used, what percentage of your portfolio it holds, in what combination with other assets, rebalanced on what schedule, inside which account types, for which tax purposes, in what proportion to your actual risk tolerance and actual timeline and actual financial goals. The instrument is excellent. The strategy around the instrument is often thin to non-existent, and the gap between an excellent instrument used thoughtlessly and the same instrument used with intention is a gap that compounds for decades. The wealthy don't think about passive investing the way you were taught to think about it. The people who actually build significant wealth using index funds, and many do, are not the people who forgot about their investments. They are the people who automated the contributions, ignored the short-term noise, and stayed deliberately engaged with the structure. They review their allocation, not constantly, once or twice a year, seriously. They rebalance when drift has moved the ratios meaningfully. They adjust the contribution amount when income grows, not just when they remember to. They understand the tax implications of where different investments are held, which funds belong in which account type to minimize drag. They have a target allocation that reflects who they actually are, not who they were when they filled out an online questionnaire. That deliberate engagement is not market timing. It is not the behavior the passive investing philosophy is warning you against. It is the maintenance of a well-built machine, which any machine requires, regardless of how well it was built. Let me tell you about a man named Thomas. Thomas opened a Roth IRA at 24, put it in a target date 2055 fund, and set up a $200 monthly automatic contribution. Textbook. At 32, he got a significant raise and never updated the contribution. At 35, he got married and his household financial picture changed substantially, and he never revisited the allocation. At 38, his risk tolerance, his actual lived comfort with volatility, was meaningfully different from what it had been at 24. And the target date fund he owned had no way of knowing that. At 41, Thomas looked at the account for the first time in several years and realized his contribution was the same to $100 it had been at 24. His income had roughly doubled. He had been under-contributing by hundreds of dollars a month for nearly a decade. Thomas had not panic sold. He had not chased hot stocks. He had not done any of the bad things. He had done the one thing the personal finance world consistently praised him for. He had stayed the course. And the course had cost him somewhere between $80,000 and $120,000 in what his account could have been if the contribution had scaled with his income. Set it and forget it. He said it. He forgot it. The rest is math. But there's something darker underneath this. Because Thomas's story is about under-contribution, which is the visible version of the problem. The invisible version is harder to see and harder to quantify. It's the drift in allocation that happens when you don't rebalance. When equities run up and your portfolio becomes more equity-heavy than your risk tolerance supports. And then a correction comes and you experience a loss that's larger than it would have been if you'd maintained the target allocation, not because you panic sold, but because the drift had moved your exposure beyond your comfort and the correction revealed it. Or it's the tax drag that accumulates when assets are held in the wrong account types. Bonds in taxable accounts generating ordinary income tax every year instead of sitting in the tax-advantaged account. High turnover index funds in the wrong wrapper. The drag is invisible. You never get a statement that says you paid this much in unnecessary taxes, but it's real and it compounds. Or it's the opportunity cost of holding a contribution amount flat while inflation and income growth have changed the real value of that contribution. $200 a month in 2015 and $200 a month in 2025 are not the same contribution in real terms. The former felt like meaningful investing, the latter, at a higher income and higher cost of living, is underperforming the original intention. None of these show up as a mistake you can identify. They show up as a number that's lower than it should be, for reasons that are diffuse and invisible, and you attribute the gap to the market rather than to the structure you built and never revisited. Here's the first principle: set it and forget it is a behavioral instruction, not an investment strategy. The common belief is that the ideal investor does nothing, that the best returns come from the most passive engagement. And the behavioral science supports the idea that frequent trading, emotional decision-making, and fee-heavy active management all hurt returns. That part is correct, but the conclusion people draw, that any engagement with your portfolio is dangerous, that looking is the path to tinkering and tinkering is the path to destruction, is an overcorrection that conflates informed oversight with emotional reaction. The reframe is this: passive investing means low fees, low turnover, and absence of market timing. It does not mean absence of intention. It does not mean never adjusting your contribution. It does not mean a one-time allocation decision that runs forever. The behavior you're protecting against is the behavior of the scared investor who sells at the bottom. The behavior you're protecting is the deliberate annual review where you ask, is this structure still right for who I am and where I'm going? The identity shift is from I don't touch my investments to I maintain my investments the way I maintain anything I care about. Not obsessively, but intentionally. Those are different investors. The first one has made a virtue of neglect. The second has made a practice of oversight. And over 20 years, the practice of oversight produces meaningfully better outcomes than the virtue of neglect, even with identical instruments. And what happens next is the part most people miss. Here's the second principle: the contribution rate is the most powerful variable in your investment account, and most people set it once and move on. This is the one that stings because it's so simple. The market does what the market does. You cannot control it. The fee structure of low-cost index funds is already optimized. You cannot meaningfully improve it. The tax efficiency of your account types has a ceiling based on contribution limits. But the contribution amount, the actual dollars going in, is a variable entirely within your control, and it is the variable with the largest absolute impact on your outcome, and most people treat it as a one-time setup rather than an ongoing decision. Every time your income grows, there is a window, typically 6 to 12 months before lifestyle adjusts to consume the increment, where you can redirect a meaningful portion of the growth to your investment account without any reduction in your lived experience. The raise arrives, the lifestyle hasn't inflated yet, and the new contribution amount feels almost painless. If you do nothing, the lifestyle fills in and the window closes. If you act deliberately, before the lifestyle catches up, you capture the increment in a way that is sustainable because you never actually experienced having it in the first place. That window is the most valuable financial moment in your calendar year, and it passes unnoticed if you're not watching for it. There's a couple, Diane and Marcus, who decided 5 years ago that every raise, every income increase of any kind would be split 50% to lifestyle, 50% to investments. Not all to investments, that's unsustainable. Half to living better, half to building faster. Over 5 years of moderate but consistent income growth in both their careers, this one rule had added $3,400 per year to their combined investment contributions by year 5, compounded from the moment of each raise rather than from some future date when they remembered to update the contribution. The difference in their account versus the control version, where they'd spent the full increment on lifestyle, was already measurable. In 10 more years, that difference will be the kind of number that changes what their 50s look like. One rule, applied consistently to the variable that actually matters. This is where it gets interesting. Here's the third principle. Diversification without intentional allocation is just owning more things you don't understand. The word diversification has become a comfort word in personal finance. You're diversified, therefore you're protected, therefore you can relax. But diversification is not a property you either have or don't have. It exists on a spectrum, And the nature of what you're diversified across matters enormously for how the diversification actually performs under different conditions. Many people who believe they're well diversified own 3 to 5 funds that, when you look at the actual holdings, are 60 to 70% identical. The total stock market fund and the S&P 500 fund are not diversifying each other. They are largely the same stocks. Adding an international developed markets fund adds genuine diversification. Adding a small cap fund adds some. Holding only large cap US equity in for different wrappers is not diversification. It is concentration with extra steps. And the allocation between equity and fixed income, the fundamental dial that determines how much volatility you can absorb in exchange for return, this is the number that needs to match your actual risk tolerance and timeline, not the questionnaires' approximation of it. Most target date funds use a glide path that makes sense for an average investor with an average retirement date and average circumstances. You are not the average investor. Your risk tolerance, your other assets, your income stability, your expected retirement date, your outside obligations, all of these affect what the right allocation actually is. And the target date fund has no way of knowing any of it. The identity shift is for my own index funds, so I'm invested correctly to my allocation reflects a deliberate understanding of my risk tolerance, timeline, and goals that I review and update as my life changes. The first person has outsourced the thinking. The second person has done the thinking and then let the instruments execute it. Over time, in different market environments, that difference is not trivial. Here's the truth about what's been happening while you weren't watching. Your investment account has been running the instructions given to it by a younger, different version of you in a different income bracket, with a different understanding of your own risk tolerance, a different sense of your timeline, and a different financial life. And the instructions were probably good for who you were then. The question is whether they're good for who you are now. And the only way to answer that question is to look. Not to react, not to tinker. To look deliberately once a year and ask, is this still right? That's not market timing, that's maintenance. And the failure to do it has a cost that is invisible and real and compounding against you right now while you're proud of yourself for not panicking. Project it forward, the undercontribution, the allocation drift, the tax drag, the failure to capture income growth, each of these individually is a modest drag. Together, compounded over 20 years, they represent the difference between the account you have and the account you could have. That difference is not a percentage point of return. It is, for many people, years of working that they could have not worked, the ability to make different choices in their 50s. The gap between enough and significantly more than enough. And none of it required you to time the market, pick winners, or do anything that the passive investing philosophy actually warns against. It just required you to pay attention to the structure and update it as your life changed. 5 years from now, the set it and forget it version of you will have an account that reflects who you were 5 years ago. The intentional version will have an account that reflects who you are now and who you've been becoming. The instruments are the same. The gap is the oversight, so here's where you are. 2 paths, and the uncomfortable one requires less than you think. The first path is continuation. You keep the automatic contributions running at whatever amount you set them at. You keep the allocation at whatever it's been. You don't look, because not looking has been the instruction, and the instruction has served you in the specific way it was designed to serve you. You didn't panic sell in a correction. You stayed invested through the volatility. You did the right behavioral thing. And the account grows below its potential in a structure that doesn't quite fit you anymore until you retire and discover the gap between what you have and what you thought set it and forget it would produce. The second path requires one afternoon a year. Not a trading account, not a market analysis. One afternoon where you look at the contribution amount and ask if it still makes sense given what you earn. Where you look at the allocation and ask if it still reflects your actual risk tolerance and timeline. Where you look at the fund holdings and ask if the diversification is real. where you look at the account types and ask if the tax positioning is optimal. One afternoon, once a year, with the same seriousness you'd apply to any important annual review. That's not active investing. That's not the behavior the passive philosophy is warning you against. It's the behavior the passive philosophy assumed you would already be doing. The index fund is still the right instrument. The question is whether you're using it deliberately or just holding it in the dark. What's in the account and when did you last check? That's where this ends and where the real work begins.